Okay, good morning, everybody. We'll go ahead and get started. And today is Wednesday, and we're in week 9. And I wanted to talk just a bit about where we are and where things are going here. And we're pretty much right on schedule with regard to the syllabus itself. I know I've made some adjustments to due dates, but I've done it really. I like to think I did it for your benefit, and I really believe that I did actually. But so in week 9, we're covering activity-based costing, which we started talking about on Monday. And I really think I'll be able to get through, I'm sure I'll get through the rest of the content related to the discussion of what it's all about. I deferred the due date for this the discussion. Remember, there are 4 activities for this particular module: discussion, homework, quiz, and bonus if you want to do the bonus. And I would encourage you to do the bonus. I probably don't talk enough about the bonus, but those who do the bonus can sometimes boost their grade by a good letter grade. I mean, I've seen it happen again and again. And you don't have to do the bonus; it's up to you. But it's available on really all the modules, and so I would encourage you to do it. So again, I've modified all these changes in due dates. I've changed in Brightspace to November 3rd. So feel free to look at that. So my plan for today is to talk about the rest of activity-based costing, which obviously it seems like we're going faster in this, but it's really not as detailed. There's a lot going on, but it's not as lengthy as Chapter 13. Chapter 13 is about twice the length in a lot of ways. If it were my textbook, I probably would have chopped it up a little bit, but that's just nobody really asked me. And so this is sort of a more an average bit, maybe even a little bit below average in terms of reading. So this kind of gives you an opportunity to spend some time this week and this weekend and also next week to read and to go over the some sample problems. And I always encourage students to go over the sample problems and exercises in the back, before embarking on the homework and quiz. It's my contention, it has been for a long time, that the best way to learn accounting is to simply do accounting. So I think that's a worthwhile thing to think about there. So then if we go on to next week, and by the way, I may not get through all the, I'm going to do some of the back of the chapter problems and exercises. I've got quite a few that I've selected to go over. And if I don't get through them all, I'll carry them into next week. And we've really got plenty of time, and we're on track with where we need to be, because next is the final chapter in this particular segment, a segment being defined as, leading up to an exam. And that's Chapter 14, dealing with incremental analysis. Now, by the way, what is really interesting about the selection of Appendix F here is that some of the thinking, I guess you could say, and some of the methodology leads directly into incremental analysis, which deals a lot with the whole what-if scenarios that I've been talking about for quite some time, that accountants are often tasked with deciding, do I do this, do I do that, do I do more of this, less of this, do I stop doing this? Those are really some of the ideas that come up again and again, really everywhere in accounting. And so that's really what's going on there. So I don't think we have anybody on the Zoom call, so I think it's just us here in the classroom. So I wanted to pick up from where we left off on Monday, and I'm going to try to adjust my focus here a little bit. So, okay, this is obviously your text. This is the last thing, I think this is the last thing I talked about on Monday, was this idea of what the logic of, and I really like this graph a lot. I think it kind of gives you it's kind of big, and it kind of tells you a good, really the whole picture of what activity-based costing is. And that is this: if we know what overhead costs are, and when I say no, I'm saying we have a pretty good estimate. It's not just some wild figure picked out of the air. It's based upon something which is based on experience, and we're going to get to the forecasting piece of this course a bit later. And so, and you'll see that a lot of the figures that are arrived at for a budget, which is a roadmap or a forecast, are not just pulled out of a hat. They're based upon experience and also future forecasting. But if you know what these costs are going to be, you can divide them up by activity, and so you can apply them across the activity within the organization itself. And these activities themselves form themselves into pools. So we can say, and it's usually on a percentage basis. We didn't really get into that element so much as to where we got these dollar figures to drop into these pools. And all pools are, as I mentioned on Monday, are simply segregation of financial data. That's really all that they are. It's not that much different than somebody setting up a Christmas club account for Christmas purchases, and having a retirement account over here for retirement, having a vacation account over here. I tend to shy away from these metaphors which involve household relationships because it doesn't usually work, but I think it does in this particular case. It's the idea that we segregate things, and we drop them into this based upon these activities, and so we're drilling and cutting and pressing and assembling, and whatever it is that we're trying to make here. And then as a result, we have to just, okay, so knowing the activities then, and I know I'm going back a little bit, but I'm just going to back up just a little bit in order to go forward. Once we know that, then we have these drivers. The drivers are the things that we're actually counting. Now remember, when we talked about the definition of drivers and the requirement of a driver, a good driver is one that's definitely related and directly correlated with the production activity itself. That is, if production activity goes up, these drivers numbers will go up. If production activity goes down, those driver numbers will go down as well. So we talk about milling and drilling and milling, machine hours. That's a very common one that's used particularly in manufacturing. Labor hours, we've already talked about as being sort of the default standard. For a lot of years, overhead was applied based upon labor hours, particularly when a lot of the inputs used in pretty much all production processes were primarily labor. And in some industries, it's especially relevant. I think it's, especially in the service industry. We'll get to the service example here a bit later. Parts assembled, square inches, square feet, whatever. And once you have these dollar figures divided by these drivers, you can apply a specific dollar figure. It could be pennies, really, to individual products that you can attach to products. But these overhead costs are more organizationally determined, and then we drop them into pools, establish what the drivers are that we're going to be counting. Because remember, what we're doing is we're applying overhead. And what does that mean? It means that we're attaching the cost to a product as that product is moving along through the production process. Now, is this going to be a perfect figure? No, it's not. We're going to see how we can over or under apply overhead. It happens. It is a simple variance, and there are a lot of different variances that we encounter in managerial accounting. And the idea is ideally, if you could get to no variance, that would be perfect, but we don't live in a perfect world. And so you're going to have variances in a lot of things, a lot of these estimates that don't turn out to always work out well. But once we know what they are, we're going to test individual products. Okay, so that's a little bit of review just to sort of back up just a bit in order to go forward. Okay, all right, we do have some attendees on the Zoom call, so that's good. And oh, by the way, let me just say one more thing. If you are watching this on the recorded link, please record your attendance on all those links. I don't think I'm really communicating that very well because a lot of people are not doing that. But please do that. Please make sure you just say, it doesn't have to be anything at all. Just say I watched the videos, and whatever day that you did it or whatever day you think you did it, that's fine. We are required to record attendance, and maybe we'll find a different method in the Attend Anywhere modality that we're trying to work with here. Okay. All right. Let's move on. So we have an income statement. This is the same income statement, I think, that goes back to the sort of the beginning of this particular module. I think it's this right here, where we had sales of $5,850,000 based upon these two products, right? Remember, it's the Atlas company that makes Nav Bench, sells for $200 a piece. The App Coaster sells for $170, and we broke out on Monday the revenue components as well as the components of product cost per product, direct materials, direct labor, and manufacturing overhead. We sort of said, well, we're not quite there yet, and we just simply said, okay, $900,000 is the total cost of overhead that the firm expects to incur. And by the way, this is not a small number in relation to sales. Remember, if we do a common sizing where we, on an income statement, where we have income and expenses, we take every single item as a percentage of sales, then this is a pretty large percentage of total sales. It's $900,000 against the sales of about $6 million. So you're talking about a good 15% or so of sales. So the point I want to make is manufacturing overhead is not incidental. It sounds like it may be just ticky-tack sort of stuff, but it's really not. It's fairly important. So, but let's come down. We're going to go back to this income statement that comes a bit later in the presentation. And I'll try to blow this up as best I can. I know that obviously you've got these in your book as well, but what's going on here is we want to talk about non-manufacturing costs that we can also include in overhead as well. This is really the same financial statement here. And when we talk about traditional versus activity-based costing, here we just simply said, okay, we don't really know what the manufacturing overhead is per unit, but this is what we have incurred for the year. And this would be, if it's an income statement, it's obviously produced sometime after the fact. So here's one other bit of change here that we're going to introduce, and that is this. Up to this point, we've said, okay, well, we have all this overhead, and we're establishing it organization-wide. We're going to arrive at a dollar figure. But what if that's maybe not the best approach? What if there are different approaches for us to look at? So, in other words, we've got different levels of activity that we can focus our attention onto. And I know this is all discussed in your book, but I want to talk a bit about it here. And that is, we can go from micro to macro, that is small picture to big picture. Okay, to this point, we've really primarily talked about facility level, where we said, okay, this facility does this, and we've incurred this much overhead. All those costs which go into manufacturing overhead are there. But we can also zoom down to the actual unit level itself, the actual unit of production, whatever it is, a pair of shoes, bottle of shampoo, pack of razor blades, whatever. Then you get to this unit level, and that's a pretty micro view of things. Or we can go to the batch level, which is where we produce an entire production run of something. And that's very common in manufacturing. And by the way, one of the reasons why I like the example in the text of the two goods being produced, even though two goods is maybe still a little bit of an oversimplification, it does indicate that business firms typically don't make one product. And I know that we often, in accounting classes, have this assumption that ABC company makes one product, and sells it at one price and all that, and that's not really correct. In fact, a lot of companies do a lot of different things, particularly manufacturing companies, and they may engage in different production runs where they produce a bunch of one thing and then stop and retool, reset up, which is why setups are sometimes a driver in this particular case, and then kind of move on to do something else. I know that there's a guy I knew who worked at the General Mills plant on Paseo, and I think they make, what do they make? I think Lucky Charms, Blueberry, and
Cinnamon Toast Crunch.
Was that what it is?
I know that's one of the things they do.
Okay, and he would talk about the fact they would make a bunch of one thing, then stop, and then make a bunch of other things. And so, and I think what was it? Was it chocolate? Something Count Chocolate?
Count Chocolate maybe?
I think they used to make Count Chocolate because I used to drive by. I used to drive by there on the way to the West Side campus, and I would smell chocolate. I'd say, "Where's the chocolate coming from?" In Albuquerque. And so, but he would talk about the fact that they would make a bunch of Count Chocolate one day, stop, and then rework everything, and then start making a bunch of Blueberry and whatever. And so you get the idea that at a batch level, this is where we can sort of self-contain activity, which is really what we're sort of getting at. And that's just another way by which we can create the activities. Or product level, that is, individual products themselves can absorb the costs. And facility level are the ones we've sort of talked about up until this point. Okay, so, and then we get to this, and this is probably hard to see on the video screen. I don't know if it is or not, but this kind of breaks it out. And what I think is interesting here is the fact that we talked about these four different levels. This is just different scopes of analysis. We have unit level, batch level, product level, facility level, and we get to the types of activities themselves. So if we're doing units themselves, maybe it's machines that we're working with, we're cutting, but whatever machines do, and the driver would be machine hours. I think that's a really particularly applicable and relevant example. Labor, of course, and there's nothing. I don't mean to minimize the importance of labor and labor hours as an activity and a driver, respectively, but in areas where there's a lot more complicated inputs, it may not be particularly appropriate. But in this case, things like assembling, all the things that workers are doing, and we can measure their direct either hours, which is a number, or cost, which is a dollar figure. When it comes to batch level activities, things like setups, purchase orders, inspection, materials handling. By the way, there's an entire bunch of academic literature that talks about the idea of just moving things around and how that's an activity in its own right. And for a lot of business firms that do nothing really but move things around, that would probably be a pretty good driver. The number of inventory moves, material moves. I'm thinking of Amazon, I'm thinking of UPS. They don't really make things, they move things. And so as things move along the production process, maybe that's a good driver for being able to capture, to attach overhead to product level activity, things, product changes and whatnot. And this is what we've really gotten to this point where initially, when we first started talking about overhead, we give all these examples. We talked about things like, and these were sort of the classic examples of costs, and things like factory management salaries, depreciation on equipment, property taxes, utilities. And so these are facility-wide costs that we can attach activities to and establish pools. And so what would be the drivers? And one big driver would be square footage, which is almost always a big one here when it comes to facilities management. And I'm thinking particularly of companies that are wholesalers or retailers where their activity is directly correlated to the usage of square footage. And I'm talking about the usage of square footage, not the square footage that exists, because sometimes it isn't all used. There are lots of organizations that have lots of extra square footage that aren't used at all. And if you've ever been through a plant before that does anything, a lot of times you see like a whole section of the plant that's not even being used because it's there for future expansion, it's there for storage if you need to sort of put excess inventory. It's kind of a catch-all space. So the utilization of square footage, which all of this can be measured. Remember that the drivers themselves are the things that we're tracking, we're clicking them off, and we're attaching the overhead that belongs to that particular driver. Okay? So any questions about that before we move ahead here? Okay, well, we're sort of nearing a bit of the end, and we'll talk a bit about service sector costing. And but some of the advantages that we've talked about before is the fact that we can better judge activities in terms of, are they essential, are they not essential? In other words, in the parlance of economics and finance, are they value added or are they not value added? And here we got to be a little bit careful because sometimes people take offense at classifying their activity as a non-value added activity. Because I think sometimes people will think that we're talking about non-value added or non-essential people. And that's not what we're saying. We're simply saying, is the activity that they're associated with, if they're associated with, adding value to the actual product itself, or are they not? The idea is to enhance the efficacy of value-added activities because they are essential to be able to produce the product. And is it going to create value in the minds of customers? And by the way, we have spent very little time in this course talking about customers yet. And this is one criticism of accountants is they're so internally focused on costs and what things are, how efficient things are running, that we don't think about the idea of value to customers. And without customers, though, you have no product to sell. So you can be as efficient as you want in making something nobody wants. And so value-added activities are essentially those things which add to the value of the product at the end of the road. And the end of the road is when the good is sold. Remember, when the good is sold, we're done. We're done accounting for the product. It belongs to somebody else. We simply add it to cost of goods sold and it's done. And we want to keep on making products and making products and making products. But non-value-added activities are those that, if they were eliminated, they wouldn't necessarily reduce the perceived value of a company's product or service. So, by the way, I know that we've all heard over time about companies who do occasional layoffs or plant closures or store closures. We've heard a lot of that. I mean, Starbucks has closed locations across the country because they just simply aren't really carrying their weight. We've seen retailers go out of business, Sears, JCPenney, simply because they're not there, and customers really don't perceive value in those. But when these layoffs happen, they oftentimes happen in this area here. And what they do is they add cost, they increase time, they essentially burn up resources. And if they are not as value added as the value added activities, then they're very often the first on the chopping block. Regrettably, and by the way, accountants are probably the first in line here. They're certainly not. They're not the last who may be laid off in the event of these particular things happening. But here's a graphic. It's a little bit tricky to follow. When I first saw this, I thought, "What in the world is this?" But if you just kind of look at this, I think this is an interesting chart. You've got activities sort of spread across here. Okay. All these different inspection, moving to storage, storing finished goods, and we have identified these as value added, which are the red symbols here, and non-value added. That is, do customers perceive value? And keep in mind that if we can improve efficiency in value added activities, that's great. If we can improve efficiency in non-value added activities, that's really great as well. And because it saves us money, and the customers have no idea what is really going on. I don't personally believe customers care what the problems are of businesses. I just don't think that makes sense. I know I'm probably the oldest person in this entire section, but I can remember the day where people said they really cared where products were made, whether they're made in China, whether they're made in Mexico, whether they're made in the US. I think customers could care less where products are made. I think they just want the idea the product to be valuable to them. Having said that, then, if we can improve efficiency behind the scenes in order to make a good more profitable for us to make this all to the good. So we've got the days, and I'll sort of wrap this up. You've got days and assigned to each particular activity. And the value-added activities, there's probably no real improvement there. But what if we can if we can cut back on moving and storage from 12 days to 4 days? Wow, what a savings. Moving materials from 2.5 to 1.5 days. There's no change with setting up machines. Moving and waiting, it's kind of 6 days to 2 days and whatnot. So you kind of get the idea. And by the way, this has been a big push in the business world for the last 40, 50 years, is trying to do these things behind the scenes much quicker, much faster. In particular, this idea of trying to reduce the value of inventory sitting around, because all inventory really does is absorb cost and eat up value until it's sold. And so if companies can reduce the value of inventory, all to the good. So for anybody here who's I know probably most of our students are business majors, and so if you're going to be a major in operations management, you will definitely be hearing more about these concepts that relate to things like infrastructure management, how we can improve efficiencies and whatnot, and that's really all to the good. Okay. All right, and so some of the advantages of activity-based costing is to obviously reduce cost, and so activity-based costing then lends itself to a particular, management philosophy is the term, but it's really an idea that is concentrated on what the thing that I just talked about: efficiency, cost improvement, making things better, cheaper, and faster. And to the extent that can happen, activity-based costing informs the implementing managers in this regard. So, and it can be used for both strategic and operational decisions. Now, what does that mean? This is probably not really in our focus in this course. Strategic management really relates to this idea of what is it we're doing? What's our mission? What's our vision? What are we producing? Who are we trying to serve and whatnot? And one way to improve our strategic goals is to use something that makes life more efficient and cost effective. Operational decisions are more on a day-to-day sort of basis. And one that and of course I made a comment here since it's in green: top managers evaluate employees, departments, and business units. Business units tend to be a distinct area of business that's separate from another. And as a result, they operate almost like little businesses in their own right. Many companies have different units that operate like their own little companies, and they may be headed by a vice president who really acts more like a CEO. They have their own separate budgets. They can determine profitability, And very often they know nothing about other parts of the company whatsoever. And I know when I first started in the business world, I was working for very large companies. Many times our business units, we didn't even know the people in the same company. And why would we? We're in the same building, but we had nothing to do with one another. And so as a result, if you could, again, you could drill down into and narrow the focus of performance to these individual business units. And for those of you who will go on to study and do a bachelor's in business, you'll probably get more of this in a strategic management class. But the thing that I think is important is compensation systems very often can be tailored to include cost savings and or efficiencies. And there are some companies, I know that I was involved in a company once, which had an incentive system that would share the savings with employees if they could find out and determine ways to save money on doing things. And they would, it wasn't a particularly rewarding area. I think they would give us they would give the person 20% of the first year's savings, and that would be it. You know, I would have liked a bigger one. But the very first person who trained me, she came up with some recycling. I can't remember. I was trying to think the other day what it was, but some recycling thing that we would do. They had to do with videotape, and they determined that there was cost savings. It was a good idea. Nobody had thought about it. Thank you very much, and we'll pay you your incentive. And so that's one way to do it. Or on a regular basis, not just these one-off sorts of ideas, but you know, managers can be evaluated on how well they control cost. And cost savings are always important. Efficiencies are always important. And the key thing is to try to improve productivity. Okay. And when we talk about activity-based costing, and we're sort of getting down a bit toward the end of this before we get to the service piece, is that some of the limitations here is that number one, it's activity-based costing is complicated, it can be expensive, particularly when you're talking about lots and lots and lots of different drivers. And as I mentioned on Monday, that there are some companies that have hundreds of different cost drivers and all these cost pools that they are tied together with. And somebody's got to measure these, and that's okay. And to the extent technology can be used, that's all to the good. But somebody's got to sort of untangle this and apply these to product costs, particularly in looking back at saying, hey, are these 5 different brands of tennis rackets, which are more profitable than the other? And by the way, there's a great tennis racket example coming up in the next segment that next module we'll get to. So they're more complex, and sometimes as best we try, there are going to be some arbitrary allocations to individual products. Some things just don't lend themselves well to product cost. But they don't really have drivers attached to them. There are no drivers, but yet they're overhead, and they are product costs that should go into the costing of the product itself. Things like insurance on the premises. I'm talking about the production premises, depreciation of the equipment, property taxes. There are drivers behind this, and so we have to kind of make some arbitrary decisions as to what to do with that. And in those cases, I think what we do is we kind of go to that global sort of big picture total cost divided by units of output and drop those onto product cost, even across multiple product lines. There's just no real other way to do it unless you can tie it to those particular things. For instance, if there's machinery, and we're talking about depreciation on machinery that only makes one particular output, that's a pretty easy one, so we can account for that cost there. But what about property taxes? There's just no driver. It's you get a bill and you pay it. That's really it, right? And by the way, you're going to pay it whether you're making output or not. That's the crazy thing about property taxes on production, is you're going to pay it whether or not you're making product. And the same really goes for insurance in that regard. So you've got to kind of figure out a way to allocate that. And this is why bigger is oftentimes thought to be better, is because of the fact that as you produce more output, you spread these costs out over more units of production, hence lowering your production costs. And this is not a new story. This has been going on forever. And this is why big firms get bigger and smaller firms either get bigger or cease to exist, frankly. Okay? All right. So any questions about some of the downsides of activity-based costing? By the way, I know that sometimes students will ask about, is this applicable to a small business, and I would say, well, if you can make it work, fine. I personally, I don't think a lot of small businesses are equipped to be able to set up cost pools and establish drivers and to be able to measure these drivers themselves, unless it's an area that is easily measurable, or if it's a type of activity that is where the drivers are capturable very easily. And I'm thinking labor hours, and to that extent, maybe. Okay, my experience is that's not necessarily the case, and I think that among the challenges that small businesses have is trying to really understand what the cost of their output is. I mean, output is the value of the output to the customer is the revenue that one receives, but the cost to the producer is obviously the cost and the internal cost. And so I think it's very, very difficult. And I don't know that this is always the easiest method to apply overhead for smaller firms. But for bigger firms, it is very much in vogue and has been for some time. And there are other systems as well that sort of build upon this. And there are companies that have their own unique twist, their own unique variation. And sometimes they don't really want to even talk about what they're doing because they think there's such a unique way of doing it that it's just for them. Remember, this is internal accounting. This is not for the rest of the world. And then one final thing here talks about data analytics. And data analytics is not a new term, but it's people kind of think it's something new, particularly when we attach it to artificial intelligence. And AI is far and away the biggest story in the business world at the moment, and is likely to continue to be that way, particularly generative AI, where you can put in a question to, I don't know, ChatGPT or Copilot or whatever, and you can get some kind of answer back. But you can also tailor these systems in order to solve business problems. And so automated systems can do a lot of things better, cheaper, and faster than what humans can do. It is amazing technology, and I'm not an expert in the area. I have worked with AI a little bit, but just a very little bit. And these systems are incredibly powerful, and they can allow companies to determine what it is they're doing, particularly how we reduce the cost. And it's really, when we say reduce, we mean reducing the cost of non-value-added activities. If the activity doesn't make sense, we should probably stop doing it. And by the way, I mentioned, I think on Monday, it was this class that I mentioned that, and we'll build upon this more when we come back in chapter 14, incremental analysis, where there are occasions in which businesses are involved in some production of some output, and they decide that whatever the next step in that production needs to be subbed out to somebody else who can do it better, cheaper, and faster, in which case they can do it. And they can send it to them, they can do what they can do, that they can send it right back to them. And it happens. And it's all to the good. And to the extent that we can lower the cost of producing output, there is a great potential we can lower the price to buyers. And I don't think anybody is of the mind that lower prices to buyers are a bad thing. Okay? All right, one final segment here, and then we're going to move in. I'll do a bit of problems from the back of the chapter. We'll talk about the service industries themselves. Now, I've talked a bit about service industries sort of intermittently in this course, and I've said that service industries are growing much faster than manufacturing are in this country. A lot of manufacturing activities, frankly, have left the U.S., and that's a concern to some people. But it doesn't mean that we don't make things here. And I know that sometimes we get people saying, well, we no longer make things in America. Well, we do. And we're making more stuff than ever before, but it's just that what's growing faster are service-connected businesses rather than manufacturing. And the reasons why manufacturing a lot of times is moving around the world is, once again, not a new story. It's to go where costs are lower and regulation is lower. And that's sort of the name of the game, particularly when you're making a product that is the same as everybody else is making it. Then it becomes about price. And how do you get price lower? You lower the cost of production. So that's kind of the story of manufacturing. It's a bigger story than what we're really going to get into here. Other than to say that the service industries are growing much faster. We're talking about all the areas in which there's essentially no inventory. That's one of the characteristics of service industries. You go to an attorney, the attorney doesn't have inventory. You go to an accountant, an engineering firm, there's no inventory sitting around. They're not selling stock in trade. So it's a growing area. And so what does this mean then in terms of how do we bring overhead to individual outputs? Well, it's possible. And there's no question. Just like an example that when we first started talking about product costing, and I mentioned that there's a WIP account, work in process, and it was specifically in our module relevant to manufacturing. But I said, look, even in the accounting field where I had worked at one time, we would talk about tax returns we were doing as being work in process, and we're not done with it yet. And when it's done, it'll be a finished good, and we'll book the revenue for that, and we'll move on down the road. And at some point, we'll determine what it costs us to do all that, right? And accountants typically charge by the hour, and so as a result, that's just one example of the fact that these manufacturing concepts apply to service industries. So it's not, it's not really that much of a departure. Okay. So what's the objective? Is to find out what the activities are that are generating the costs. Remember, costs are internal to the organization. And so what are those? What are the things that we do, but because we do them in order to produce the output which we need, but nonetheless create costs. And so as a result, we can still establish activities, the pools that are associated with those activities, and the drivers which are used to measure the activities that are being done. Okay, and again, we can also talk about value added versus non-value added, and oftentimes we're going to use more of a company-wide overhead cost, because here I think you're going to have a lot of overhead that simply is just too difficult to apply to individual products. And I bring up the accounting firm example. Well, first of all, it's an accounting course, so I think it's particularly relevant. And that's definitely a service industry. Accountants make no physical output at all, and there's no tangible inventory that we can look at. And if you take a look at some of the costs, things like insurance and employee benefits and whatnot, those are difficult to sort of apply to individual work that's being done. But it doesn't mean it's impossible. Okay, so in this case, we have a CPA firm. Okay, check and double check. So it's a CPA firm, and this is going to be an annual budget. Now, this is interesting because this is not an income statement. It kind of looks like it, right? And it would be what we would, if anything, we would call a pro forma income statement. That is a projected income statement to come, but it's a budget, and it's projected of what we're going to earn in for the firm, what we're going to earn in revenue, what our direct labor costs are going to be. Notice direct labor, far and away the biggest cost, which is not unusual at all in a service-oriented business. Estimated overhead of $600,000. So total cost of $1.8 million, which gives us operating income of $2.2 million, and then everything else would come below, non-operating items and all that. But this is not an income statement. This is a budget or proposed budget. And so this is what we expect to earn from an operating basis based upon our particular projections. So if we have $600,000 of projected overhead and $1.2 million of direct labor, and remember, direct labor in this case is almost always the driver that's used to assign overhead. Well, $600,000 divided by 1.2 million is 50%, which means that what? For every dollar of revenue that we're generating, we are creating 50 cents. I'm sorry, every dollar of expense. Every dollar of expense, not every dollar of revenue. Every dollar of expense, we also have to add on 50 cents of overhead cost to attach to that. And it is possible to do it, particularly if you have the ability to segregate activities. And remember, I want to go back to something that we talked about on Monday as being really a defining characteristic of activities and pools within those activities is we've got to be able to separate these activities. They've got to be more or less discrete from one another. The overlap has got to be minimal, if any, and we've got to be able to establish the costs that go with those activities. And so that's the key thing here. In this case, it looks like we're just going to do one predetermined overhead rate. In other words, that facility level focus in this example. So I think this is an auditing firm, as I remember. So in this case, check and double check. records 140,000 of actual direct labor cost during its auto Plano molding company, which was built in auto fee of 260,000. Under traditional costing, 50% is the rate for applying overhead. Check and double check with complete overhead, applied overhead, and operating income is shown. All right, so they bill 260, right? That's their billable hours times number of hours, basically, right? 260,000. They incur direct professional labor of 140,000. That's the work of accountants and auditors and bookkeepers. And applied overhead is half of that. It's 50%, so 70,000. So together, 210. So 260 minus 210 is 50,000. Okay, that's using an overhead system that is it is more or less global in nature, and by global I mean big picture, facility level, going from there. This may not be the most accurate way of doing things. I'm not saying it doesn't happen, because I'm quite sure that it does happen in business firms where it's just too difficult. Nobody wants to really mess with trying to establish cost pools, and I get it. And these dollar amounts, maybe you could say, are modest enough that it probably wouldn't pay, or maybe wouldn't pay, I don't know, for an implementation of the system. But nonetheless, what if we did a system where we did estimate the activities? So for an audit activity, we were going to say that there are 3 different cost pools: administration, customer development, recruiting, and training. I don't know if these are the most relevant to an auditing firm, but it doesn't really matter. And so in the case of administration, what drives administrative costs? The number of partner hours. And notice we've got 335,000 that are attached to that. Now notice that oftentimes this is going to be very often the case. Anything related to labor in a service organization is going to take up a big portion of the budget. So in this case, because obviously, if you think about the quantity of the value of input, I can't think of much more value of input than professional hours being incurred here. Then overhead itself will be allocated more to that particular driver than to the other drivers, which are customer development, recruiting, and training. In the case of customer development, the driver is revenue build, okay, which is sort of the payoff for developing customers in the first place. Recruiting and training, whatever. I can think of some other drivers or pools that might be a little bit more applicable, but it doesn't really make any difference. So 600,000, that was the figure that we arrived at in the budgeting process. So if we estimate on an annual basis, right? 3,350 hours of professional partner hours being generated, then you can divide this by that and get $100 per partner hour. Meaning that every partner hour is going to attach $100 of overhead to that particular activity based upon that driver. And the same goes here. We got 160,000, and if we're measuring it by 4 million, it's 4 cents per dollar revenue. And by the way, this is not unusual at all. They're very tiny amounts that are applied to individual products that are absorbing overhead based upon some activity-based costing methodology. 105,000 divided by 30 is $350 per hour. So as a result, these are amounts that can be attached to product hours. And so what is the upshot of this? Well, if we do a comparison here, and before we do the comparison, I guess we'll do this. We'll sort of lay it out on an Excel spreadsheet, which we love. Accountants love Excel, right? And all we're doing is simply recreating the pools, the drivers, the quantity of the expected usage of those drivers, and then the rates that we just calculated. And we're going to get, we multiply all this out, we're going to get 57,200 for this particular job itself, okay? And right now, let's not confuse ourselves between job order costing and ABC costing. Job order costing is all costs together. I mean, if ABC costing is just overhead, that's all, that is all what it is. So there's no contradiction. It even applies in process costing, which certainly was the example I think we were probably using in the example of the ab coaster and ab bench. So, all right, well, remember, let me just back up here a little bit. Before we had, where was it here? We had, okay, so we had, what was the number? Did I lose it here? We're saying 50 cents on the dollar was going to be applied to all that, and we're going to arrive at 50,000 of operating income. That was sort of the bottom line. Okay, based upon the 50 cents per dollar of professional labor, labor being the only driver, one single driver, and we get 70,000, and which gives us an operating income for this particular activity. This one particular job, 50,000. So okay, under activity-based costing, then what have you got? You've got a little bit of a different scenario. Your applied overhead, which was 70,000 under a traditional costing method. And again, traditional costing simply causes the firm to hang its hat on one thing. It's direct labor, either dollars or hours. Same, it was really the same thing. We had 70,000, which led us to an operating income of 50,000. Here, under the ABC costing, where we're getting a little bit more definitive, we had total overhead cost of 57.2, and so as a result, we end up with a different figure for operating income. And I think that's important for us to realize, is to the extent that we can track these activities and be able to better assign overhead, all to the good. And overhead, again, is not a minor line item on an income statement. If it were a minor line item, we'd just expense it and say we're done, right? Just like in Principles 1, the first class, I know sometimes in the textbook we talk about supplies, how we're going to book supplies, and we're going to buy $1,000 supplies, then we're going to go back and we're going to count the supplies, and we're going to reduce by $300 or whatever. In reality, a lot of companies would just say, supplies what? What are we talking about? Paper, stationery, envelopes, toner. Let's just expense it. It's not mess with trying to account for it. If it's like that, if it were a minor item like that, we probably wouldn't mess with it. But you're talking about $600,000 on revenue of 5 million. What was it? 5 million 50 or so? Oh, let me see here. Well, whatever. I think it's 5 million. It doesn't really matter, but I mean, it's not a small number. So, you know, we have to understand that these are not insignificant costs, and that these are costs that we should be aware of. Okay. All right. So, any questions about anything with regard to the content of this chapter? And if you do have questions, that's fine. If you don't, that's fine too. If you want to hold your questions, that's also fine. So, what I wanted to do is, hold on a second here. I'm trying to bring up the sheet. You can see that or not. Let me bring it over here. Maybe that's okay. So I want to do a few of the back of the chapter exercises in the back of the chapter there. Okay, and this is really sort of an effort to kind of go over, you know, what some of the things you're likely to see on the homework quiz and bonus. And as you're approaching that, if you do have questions about it, yeah, feel free to reach out and let me know what your questions are. And it's I'm more than happy to go over that. So so I want to go to, I've sort of selected a few that I think are probably worthwhile, and I want to go to some of the brief exercises in the very back of the chapter. So let's do that. And I want to go to brief exercise number 6 here. And unfortunately, just given the circumstances, I'm going to have to take this text down, take the screen out in order to do what I'm doing here. But in this case, what do we got? So we have Weissman Incorporated uses activity-based costing as the basis for information to set prices for its 6 lines of seasonal codes. To beat the activity-based overhead rates using the following budgeted data for each of the activity cost pools. Okay. And so we've got, looks like we have 3 pools, and pools are based upon the activities, those internal things that we're doing. So sizing and cutting, stitching and trimming, wrapping and packing, and we have estimated overhead for all of these. They're allocated based upon whatever logic makes sense, a lot of its experience. And then we expect in this coming counting period to do 160,000 machine hours, 80,000 labor hours, 32,000 finished units. Well, this one is relatively straightforward, and I think you will find the math to not be a problem. I've said for a long time in this class that the math is not your enemy because it is, or it should be, relatively straightforward. So let's kind of do this. Let's sort of lay this out in a very logical manner. This is brief exercise F6, and so let's establish what the pools are in the first place. Remember, the activities themselves are identified, and then we establish the pools themselves. So we have an activity cost pool. And then what we're going to do is we are estimating the overhead that applies to that pool. And right now, we don't really care where the number came from. It's just that we know that it's there. We're going to talk about the estimated usage. And estimated usage of these drivers, right? And this is going to be a countable number here that we're going to be looking at. And oops. And then we're going to get to the overhead rates using the ABC methodology, okay? And by the way, it's going to be basically this. It's going to be estimated overhead, and it's going to be sort of divided by estimated cost drivers. It's going to give us that. So, okay. So the math again is not the main issue. It's accounting. In fact, I know that we've said many times before that accounting is not really about math. It's more about being organized, but we express things in dollar terms. So what are the pools? The pools that were given were sizing and cutting. That was the first pool here. And we're told that the estimated overhead that applies to that activity in the pool is 4 million. Estimated usage is going to be 160,000 machine hours. Machine hours are a very common driver, particularly where there's lots and lots of machinery involved, right? And so as a result of that, 4 million divided by 160 is going to give us a rate of $25 per machine hour. And as we're clocking machine hours and producing coats of all various kinds, we're going to be attaching that dollar figure to that. But we're not done there. We have also stitching and trimming. That's the second of the pools. And we said allocated to that was 1,440,000, and we expect to use 80,000 labor hours. Okay, so that makes sense. This is a very labor intensive activity. So this divided by this is going to give us $18 per labor hour. So every labor hour that's incurred in production, not in the home office, in wherever, but rather in production, we're going to absorb $18 per unit of that particular issue. And then wrapping and packing is the final activity here. We're allocated 336,000 to that, and we expect to use, and the driver here is going to be units, produced units. It says 32,000 finished units. So this divided by this is going to give us $10.50, and $10.50 per what? And it's basically per finished good. Okay. And I think that's all they really want us to do here is to simply identify those. And again, this is a pretty good illustration of the four-step process, right? Find out what the activity is, set up a pool, estimate how much overhead applies to that, identify the drivers, and then we'll divide the driver usage, which are measurable in numbers. Dollars is numbers, and dollars divided by numbers is always going to give us $1. That's going to give us a per unit applied rate, not one predetermined overhead rate for the whole organization, but nonetheless one rate that you can apply based upon activities, because different activities and different outputs are going to require different usage, and not all goods that are being produced are incurring the same sorts of costs because they have different activities, different personnel, different cost structure. All that is oftentimes very, very different. So we have to be cognizant of that. Okay. Okay. I like the next one as well, and it's also relatively straightforward. Actually, you know what? I think this is the same. I was going to do number 7, but it's really basically the same thing. It's simply taking. You've got the activities here. In fact, it's almost identical. Where you've got the cost pools, the overhead, and the number of hours there, and so I think I might not do that. I'm kind of running a little bit long time. So what I want to do is I want to go a little bit, jump ahead a little bit here, and go to one of the exercises, not the brief exercise, but the exercises. And I want to go to the first one, which is number one here. And this is one, it's a little bit more involved, so it's going to take a little bit more time. And if I don't get through all the examples that I wanted to do today, I'll certainly pick it up on Monday, and then we'll go into the next particular module. But in this case, what do we have here? We've got Saddle Incorporated has two types of handbags, standard and custom. So again, we have two different outputs, all right? The controller, who's the chief accounting officer, has decided to use a plant-wide overhead rate based on direct labor cost. Yet the president has heard of activity-based costing. Let's see how the results would differ if the two, or if that system were used. And so what we're doing is we're going to do a comparison between traditional methods using labor costs, labor dollars in this case, and an activity-based costing. It's based upon some pools. We really got two pools here, machining and machine setups. And then the total estimated machine hours are going to be 2,000, and the estimated setups are 50. And here's the information related to the cost drivers themselves, where you've got, remember, two outputs, standard, whatever these are, whatever standard and custom are, standard and custom, and you've got direct labor costs here, different. So, and we've got a total overhead cost of 240, of which we're going to then divvy up between the two products, and that divvying goes this direction. The machining cost pool, that's the one driver, machining, is 140,000, and the other is machine setup, and 100,000 goes to that direction. So, and then the question asks us to do a number of things here. Number one, compute the overhead rate using the traditional approach, which is going to be pretty straightforward, won't take very long to do. B, compute the overhead rates using the activity-based costing approach. That's based upon the two different products and the two different pools or activities. And then C, determine the difference between the two. In other words, make a distinction and sort of a compare and contrast kind of thing between these. And so let's do that one. This is on page F23. Appendix F in your text. And yeah, the e-text, you want to find the appendix. It's not in order because it's obviously not numbered. You want to find that in order to get these problems. So let's do this one. It's a little bit more involved, and but I think this is one that probably is even more relevant than this. And in that, it sort of mirrors some of the types of questions you might see on homework, quiz, bonus type activities. Okay. All right. So let's do this. And so we've got in part A, I'm going to kind of pull this up real faster just to refresh my memory as to what we're being asked to do here. So give me just a second. We're being asked to compute the traditional method first. Okay. So let's do the traditional method here and see what that looks like. So we're going to call this is exercise F1. It's an appendix F. So, and we're going to do part A here first. So in this case, we're given, in the traditional approach, right? It's basically going to be estimated overhead, which we're given here. And it's going to be based upon estimated labor costs. Not labor in hours, but labor in dollars, okay? And then that's going to give us a predetermined overhead rate. And that is under the the traditional costing method. So it's going to be one rate, and it's going to be one size fits all. All products that are produced are going to receive the same application of overhead based upon the incurrence of labor dollars, okay? So we're given the dollar figures. We're saying it's 240. That was given to us in the case. Estimated labor cost. Well, it's going to be, there are two products. And so one is going to incur 50,000. The other is going to incur 100,000. So together you're going to have 240,000 over 150,000. And that's going to give you then a figure of 1.6, which is the same as 160%, which means what? As you're incurring labor dollars, you're also dumping into overhead cost $1.60 basically. So for every dollar of labor hours you're incurring. That's a pretty big overhead rate, but that's the answer to part A, okay? Is that. All right, part B, which really wants us to get into the ABC costing, because the president of the company says, hey, I hear about this thing called activity-based costing. What is it? Can you do a comparison? Not an unusual scenario at all for accountants to be tasked with something that management wants them to do. So we're going to go back to our similar methodology. We're going to establish the pools, right? So what are the activity pools? There are only two of us. There are two that are given here, and they're machining and machine setups. And I take it that machining is simply the operating of machines. I think that's probably what that really means. And we've got the drivers, right? So what are these cost drivers going on here? Machine hours, which is again a common driver to be used. And the other is the number of setups, okay? That is setting up machinery for whatever's going on. And the estimated overhead is sort of given to us in this case. Remember, it's given at 140 for machining and 100,000 for machine setups. Together, that's 240, and that was the amount given to us by management based upon their budgeting process. And so they're saying this is what we can expect to be incurring this particular area. So let's determine the overhead rates then. So in the case of machining, let's say, let's take the first of the activities. We've got machining, and we've got 140,000 that is dedicated to that. That comes from right here. That's just basically given to us. And we have two different outputs, and we have two different amounts of machine hours. Those are given, and unfortunately, I can't easily flip between here and the textbook, but we've got really 1,000. That's 1,000 hours that go to one unit of output, or one distinct output, and 1,000 in the other output. That's going to be 140,000 divided by 2,000, which is going to give us an overhead rate of $70. $70 per what? $70 per machine hour. Okay. Remember, these are two outputs, and they each had different amounts of usage of drivers, 1,000 and 1,000. So that's for the machining activity pool. How about the setup pool, right? Machine setups. And in this particular case, you're given $100,000, right? Dollar figures. $100,000 that was simply allocated here. And one of the drivers, these are numbers of setups, and we're given in the case that there was 400 setups for one output and 100 for another output. So the math again is really relatively easy. 100,000 divided by 500 is going to give us $200. $200, what does that relate to? It's $200 per setup. Yeah, $200 per setup. So those are the overhead rates that are determined to be applicable to these two particular outputs that we're doing. Okay. And then we have one final piece. I think we're almost running out of time, so this will probably be the last thing we do, because this will take a bit of time to sort of do a comparison. And I'm hoping I can erase this. The good news is that we have a video, so you can always stop and do whatever you want, analyze it and whatnot. So it's maybe one of the advantages of the Attend Anywhere is that we can sort of stop and take our breath. But I'm going to go ahead and erase this. This is not relatively difficult. Remember, we have a 160% or 1 times 6 factor on predetermined overhead rate based upon direct labor hours in the traditional means of doing it. Okay, but we want to do a bit of a comparison here of the traditional costing method. So in this case, if we use traditional costing, and I want to sort of do a bit of a side-by-side here. I want to do traditional, which again is based solely on labor hours, which may be fine in some cases. It may not be fine. In this case, we're going to see. And we have two different outputs. We have the standard output, and we have the custom good. I have no idea what those goods are. It doesn't really matter so much. And under traditional, we have what? We have costs that are being incurred here, and we had $50,000 times 160 for the standard good, right? And remember, times 1.6 or 160%, whatever you want to put it, and that gives us $80,000 for the standard good. And here, these are labor dollars, right? And here we have $100,000 times the same 1.6, and we're gonna move it over here to the custom side, and it's gonna be $160,000. And so together, I mean, it's all you do, simply add the columns up, 80,000 plus 160, and together you're gonna get 240, which was the amount that we determined to be applicable from the beginning, right? So 240,000, but now we're only applying it here to direct labor. We're not breaking these into their activities just yet, okay? We're still gonna get to 240 here, but we're gonna get there a different way, and we're gonna assign overhead in a different way, or when I say assign overhead, we're gonna determine what is applied overhead. So that's the sort of traditional method. Under the ABC method, we're gonna do this. We're gonna say, we have two different pools. We have machining, or two different activities. Well, I guess activities associated with pools. We have machining and we have machine setups. Okay. Again, all we're doing is the same thing. Same pools we were working with before. And we said we had two different outputs. We had standard and custom, and in both cases, this part is pretty easy. We have 1,000 in for both goods that are being produced, and we said that each incurred $70, right? Per machine hour. That was the driver dollar, the overhead rate based upon that particular driver. And so, and they both just happen to have the same usage, ironically, the same usage. And so it's going to be 70,000 for the standard good and 70,000 for the custom good. Okay. And then machine setups is the other activity level, and that was going to be what? It was going to be machine setups. We had 100 setups with one, and we determined the rate was going to be 200 per setup. That's the overhead rate per activity driver. So 100 setups in the one good, which is the standard good, that's $20,000. And then we're going to have 400 setups with the other good, same overhead rate, 200, and we'll make $80,000. And as a result, all we are simply going to do is simply add these columns up. We're going to get $90,000 for the standard good, and we're going to get 150 for the custom good, and 90 plus 150 equals 240. So we have the same dollar figure. It's not a shock. It's not a surprise. It's what we expected. But notice the differences here, because we have pretty different figures involved. We have 80,000 as opposed to 90,000. You might think, okay, 10,000 is close enough. Well, what if we slap 6 zeros onto it? Not so close, right? 160, 150. So we're off by 10,000 in both directions, right? Here we're a little bit low, here we're a little bit high. They both sort of balance each other out. Is this a huge variance? Well, I don't know. It depends on your point of view, what huge is or not. And but again, if you add more zeros to these numbers here, then we're talking about some pretty significant dollar figures. But one thing that is obvious is the fact that we know we're going to get to, or we're estimating it, of 240,000. Now, whether we incur 240,000 in actual overhead cost is mostly irrelevant. It's a different discussion. All we're trying to do is say, this is what we think we're going to incur for this particular upcoming, whatever it is, year, I guess. But we're going to assign these costs, apply them differently based upon the fact that we're really sort of drilling down into what it is we're doing. And because whatever we do incurs cost, including overhead costs that we're going to try to absorb. And so we're going to latch on to whatever it is we are doing, not just working in terms of labor hours, but also doing other activities as well. And we're creating pools of cost that we can assign as these things are being incurred. So as we're producing products, we're incurring costs, and we can apply those costs, including overhead now, much better to individual product costs, just like direct materials and direct labor, which are relatively straightforward by comparison. I realize, I know that manufacturing overhead is a little bit trickier, but it nonetheless allows a business to get a little bit more, sort of slicing it a little bit finer to get a little bit better accuracy, okay? All right, so that's about all the time I'm gonna have today to cover this. So are there any questions? I know we have some people still on the Zoom call. Okay, well, I want to do, I think maybe one more if I have time, and I'll on Monday, and I'll have to kind of see how things look in terms of the layout for all that we're going to do on Monday. So I think we'll stop for the day here. If anybody has questions about anything regarding activity-based costing, because we're going to sort of move out of this and move on to the final segment, final module in this particular segment of the class. But before we do that, I don't want to sort of leave this in case you do have questions. So feel free to contact me. I'm available over the weekend. And if I don't talk to any of you in the meantime, have a great weekend. See you next time.